Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to talk to you about the markets and all the ups and downs. Specifically in this episode, I want to talk to you about why corrections, recessions, and depressions don't matter. Let's get into it. Now, before everyone starts hate commenting, obviously depressions, recessions, and so ons matter because people's livelihood are on the line. The sad reality is if someone tries to retire right before a market correction or depression happens, it's possible that their retirement plans get pushed back another couple of years to make back some of the losses that they took in retirement. So there is a very real, sad reality that some people will end up losing their jobs, their life savings, houses, and so on in the event of an extreme downturn in the market. The reason I say that corrections, recessions, and depressions don't matter is that because the market always bounces back. Since the 1920s, adjusted for inflation, the market has always returned an average of 10% year over year. Obviously, some years are worse than others. Just think of the Great Depression, the dot-com bubble, the 2008 global financial crisis. Obviously, there's some times where years are in the red, but it also makes up for the other years where it's all green. On average, when you factor in the gains and losses, the growth is about 10% year over year. Since 1945, there has been over 125 different dips in the market. 84 of these dips happened in 1 month, returned back to normal in another month, and only dropped about 5 to 10%. 29 of these returned in 4 months and dropped 10 to 20%. Of the 125, 9 of them dipped from 20 to 40% below normal. And this took just over a year, about 14 months on average to recover. But also, when it comes to these depression era events where the market dips greater than 40%, since 1945, it has only happened 3 times. And the average time it takes to return back to normal was 58 months. So if you take all those numbers and average everything out, the average time it takes to recover from an average downturn in the market is only 4 months. But let's just say you were an extremely unlucky individual and you really wanted to retire this year, but the market absolutely tanked. Let's just say you were so unlucky that it was a greater than 20% dip. Well, just averaging the numbers from a 20% or greater dip in the market, the average return time is about 2 years. Which means if you're financially ready to retire at this very moment, but the market dips, you would only on average have to wait 2 years before you could actually retire and enjoy your retirement. Remember what I said, that since the 1920s, the market has always come back. We're talking through depression, wars, attacks, the change of economic policies, banking, going off the gold standard and onto the fiat currency we use today. Through all of that, the market has always returned on average 10%. Currently on my YouTube channel, there's a theme that we're expecting the mother of all crashes. And I wish I could tell you when it was going to happen. But all I could tell you is that pretty much everything is going to be affected. Because of the SOFR rate affecting derivatives being a quadrillion-dollar market that affects every kind of investment out there, it won't just be the housing bubble this time, it will be called the everything bubble. And I don't mean to place panic or fear in anyone's minds. I'm just trying to help all of you understand what I see and the signs that I see and why I see them, and hoping you can draw the same conclusions. But I also want to provide a word of encouragement to you all because there is always a way to beat a downed market. One, on the positive side, in a downed market, if you have spare cash reserves, you can capitalize on every company being on sale 20 to 40% or more. So if you're young, this is a great opportunity. Start now and start investing today. Sure, whatever you put into it today will probably be cut in half when this dip inevitably comes. But as long as you keep investing, you'll see some massive rewards and some massive gains coming down the pipeline, especially when you invest and start buying as things go more on sale. 45 years from now, $1,000 could turn into $85,000. $5,000 could be $411,000. And $10,000 could be almost $900,000. This is the power of compound interest and starting as soon as possible. You don't need a lot of money in the stock market, you just need a lot of time for compounding interest to take effect. Now, like I said, that is for the younger people. What about the people already close to retirement that are fearful that they're going to be completely wiped out in the event of a giant crash like I've been talking to you all about? What can they do? Well, step number one, what I would recommend is to learn market trends or hire somebody that does. so you're not completely blindsided by upcoming events. The next, make sure you're diversified. If you don't know how to diversify your own retirement account, hire an investment advisor that does. And remember, only a registered investment advisor has your best interest at heart in these investments. There's technically no such thing as a financial advisor. There's either investment advisors, financial professionals, or reps for brokerage agencies. Now, typically these reps will sell you the things that their broker offers. Things like high fee mutual funds and so on. Now, I'm not saying that all mutual funds are bad. I'm just saying that more often than not, they're extremely high in fees. And if you're close to retirement, you do not need to be bogged down with all these fees. If you're close to retirement, you need to hire an investment advisor that has your best interest at heart to give you low fee diversification. Now, you might be thinking to yourself, what's the point of diversifying if you, Wesley, are saying that this is going to be an everything bubble? Now, I don't mean to diversify between stocks, bonds, and so on in our own country. I mean to fully diversify between equities and debts like stocks and bonds, but also inside and outside this country. Invest in China, Europe, the United States, South America, so on. Get your money abroad. That way, if one country's banking system fails and the everything bubble pops in America, you still have money in other countries that can pick up the slack and not fall as hard. Now, in 2008, it was considered a global financial crisis because the entire world economy came crumbling down because a lot of people in other countries were also investing in the United States housing market as a safe industry. There is a possibility that if you diversify into other countries, you'll still be exposed to the bubble popping. If this is one thing you're afraid of, then I totally get it, because a lot of people thought diversifying out of their country would be safe in 2008, only to realize that the bubble hit that particular country they were investing in too. So what could you do in this case, where the entire world economic structure plummets? Well, there's an investment/insurance product out there called a structured annuity. And if you know anything about annuities, or if you watched my previous episodes on annuities, you'll know that this is basically an investment product sold from an insurance company. And think of it like a pension. You give this annuity a lump sum of money, and in turn, the insurance company that this annuity is with will pay you a fixed dollar amount for the rest of your life, regardless of market conditions. Now, a structured annuity works a little bit different, to where it actually provides upward potential and shields you from downward loss up to a certain percentage. Now, I'll go into deeper details in an upcoming episode I'm going to make strictly on structured annuities, but basically there is a cap and a floor. If your investments grows past the cap of a structured annuity, the insurance company gets all the growth in excess of that cap. So if your cap is at 10%, but your investments grow 20%, then that extra 10% goes to the insurance company. On the opposite side is the floor. And let's just say the floor is at 10% as well. Meaning, if the market drops up to 10%, the insurance company takes those losses, not you. But if the market drops below that 10%, let's just say 20%, then you will take the loss on that 10%. So a structured annuity is actually a great way to protect yourself and hedge yourself from massive losses in the market. Because even if the market dips 20%, you're only going to see 10% of that, or whatever your floor is. So already, yes, you're going to be losing 10%, but only losing 10% when everyone else is losing 20% or more is a great win. Now, typically, surrender fees are god-awful because they're about 7 or 8% of whatever you give them. So if you give them $1,000, $1 million, it doesn't matter, and you withdraw that money before that surrender period is up, then you have to pay a surrender fee of about 7 or 8%, which is a giant fee. But let's talk about using that to your own advantage. If you are extremely fearful that the market is going to dip massively, that would completely ruin your retirement, you could put your money into a fixed or fixed indexed annuity that technically have 0 losses. And let's just say that you're wrong and the market does bounce back sooner than expected. Well, instead of you taking that 20 or 40% loss by leaving your money invested into the market, you could withdraw all your money from this annuity and close it out and only pay that 7 or 8% surrender fee. So when it comes to fees, surrender fees absolutely stink and I hate them. But if you're very close to retirement and you wouldn't mind losing 7 or 8% over 20 to 40%, then you could actually move your money into a fixed indexed annuity or a fixed annuity, protect yourself from those extreme losses, and only take the small loss of that surrender fee. This is why I say corrections, recessions, and and depressions don't matter. Because if you find an investment advisor that has your best interest at heart, they'll be able to come up with numerous different plans and options to help you diversify and beat the market crash. And if you are terrified that this crash is going to go worldwide and affect your portfolio no matter where you put it, then you always have the option of annuities that are guaranteed income for life. I hope you got value from this video. If you did, please remember to like and subscribe because it really helps the YouTube algorithm get this channel out there. If you ever had a question, comment, or just wanted something addressed, I have a dedicated Facebook and Instagram account to answer all your questions. I don't really post there too often, but it's a lot easier and more organized to do messaging over there as opposed to tagging and replying to all the comments down in the feed. Either way though, the choice is yours, and I'll see you in the next episode.